Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here with you with my friend and colleague, Lawrence Gillum. We're going to talk some equities. We're going to talk some fixed income. Happy New Year to everybody. Happy New Year to you, Lawrence. Here's my question of the day, Lawrence. How long until we have to stop saying Happy New Year?
Ooh, that's a great question. I think, what was it? Larry David said after like the fifth day or fourth day or something like that. But we'll keep it going. So happy New Year to everybody out there.
All right. Well, I guess we're pretty close to the fourth day, but yeah, I think we'll keep it going for maybe another week. So it is Monday, January 6th, 2025. As we're recording this, the topic of the day is a report card for LPL Research. We're going to go through our calls, tactical asset allocation calls from last year, and tell you what we did well and what we didn't do well. We've certainly got some hits and misses. We'll also talk briefly about last week, which was disappointing in the sense that Santa Claus did not visit the stock market because we ended up about 0.5% down for the last 5 trading days of last year, plus the first 2 trading days of this year for the S&P 500. These patterns, you have to take them with a grain of salt, but historically, stocks do better in years when they have positive returns during those periods. Anyway, so we'll talk briefly about last week. We will also preview the week ahead, which is Jobs Week, where our expectation and the market's expectation continues to be for the job market to slow. So let's get to it. In terms of equity returns, so here you see the 5 trading days. This is most of the Santa Claus period, down 1.6%. So this isn't calendar week last week because of the holiday. It's 5 trading days, not 4 trading days. But if you just looked at the 4 trading days last week, the S&P 500 was down 0.5%. The NASDAQ was similar to that, and the Russell 1000 actually was higher. So, and I guess the recent period here, the small caps have been a bit of an outperformer. We had a little bit of weakness in some big tech names last week. That's where you see consumer discretionary, which was down over the last 5 trading days, down 3.3%. So it was an underperformer last week. And then tech was an underperformer as well, down 2.2% last 5 trading days, down about 0.75% just last week. We had some company stories. I mean, it was a low volume week. A lot of people were away. You didn't really have institutions active in markets. So we're not really going to draw any conclusions from the pattern, but I will say you had some big stock moves. Boeing was down almost 6% last week after the plane crash in South Korea. And then you had Tesla down about 5%. You had Apple week. Tesla was down on weak deliveries. Apple was down on price cuts on iPhones in China. So, that was really all. I don't think the economic data really had that much to do with how equities did, although we did get a pretty decent ISM manufacturing report. International markets held up a little bit better, but same thing. With holidays, we're not going to draw conclusions. We still like the U.S. more than international and EM. How about in the bond market? I mean, from what I saw, Lawrence, not much movement, kind of quiet.
Yeah, it was pretty quiet last week in the bond market. Again, hard to draw any firm conclusions on a very light week, 4 days of trading, frankly, over the past week, given the Wednesday holiday. So, rates on here, we're showing the ag flat for the week. That kind of carried across most core bond sectors, with the IG Corp Index, investment grade corporate bond index, down about 20 basis points. Really, if there is a theme here, it's the credit markets continue to outperform the core markets. They continue to outperform the rates market. That's frankly a carryover from 2024, where we saw really great performance out of the credit markets, the high yield credit markets, the muni high yield markets, the riskier segments of the fixed income markets that kind of carried forward into last week as well. But it was a quiet week. But December was a month to forget, frankly, because it was a pretty bad December just in general. Treasury yields up, 10-year Treasury yield up higher by about 50 basis points, ag down about 1.6%. So perhaps we're past the big sell-off in the rates market, given kind of current pricing in the Fed funds rates markets. We'll talk more about that in just a second, I'm sure. But last week, quiet. Hopefully, we'll keep the quiet theme going into the rest of the month of January.
Well, I guess the markets are loud today because stocks are up really nicely. I think 1% at last check here, midday on Monday's trading session. So certainly liking the headlines today. I think one of the headlines was that the market likes is that tariffs might not be as broad as maybe the market had feared. We also had, the big tech contractor in Taiwan, Foxconn, which I guess formerly called Hanhai, is up. Beat on revenues, strong growth, and that's carrying over into the big tech names in the U.S., particularly NVIDIA. So that is helping. And then we got some pretty decent data out of China actually over the weekend. So market's getting a little bit of a lift here today on Monday to start off the week. And we just talked about the Santa Claus rally, that we were down roughly 0.5% during that period. So not a positive indicator. However, there's also the first 5 days of January indicator, which has some predictive ability, at least it seems, on the month of January and the year. So we'll look at that one more closely as we get through closer to the 5th trading day. We're off to a very good start there, though. This is a chart. This doesn't include today's activity, but the S&P 500 rallied nicely on Friday and ended up right at the 50-day. So of course, the gains today, if they hold, will put us nicely above the 50-day and certainly keep this uptrend in place. The week breadth metrics have kept us kind of on guard for a pullback. I mean, we got a little bit of a pullback, but again, we discount any pullbacks between Christmas and New Year's when it's light trading. But we're still on guard for a pullback here because of the breadth, but the uptrend is still strong, and certainly we're not having discussions about pulling away from the equity market. We still have a neutral tactical view on equities. I still recommend investors remain fully invested. Nice trend. Here's the Santa Claus rally stats, though. Again, we did not get there. If Santa does not show, you're in the bottom panel here, bottom section of numbers, and then you end up on average with a slight decline in January. You're actually down a little bit more than you're up in January, but the yearly returns aren't terrible, certainly. Average gain of 5%, up 2/3 of the time. It's not too far off from our base case expectations for the year. Our 2025 outlook has kind of mid to high single-digit return forecasts implied by the S&P 500 fair value target. High single digits, that's not terrible, especially after back-to-back 20% up years. But that is, if you believe in this indicator, we're a little bit skeptical. But if you believe in this indicator, then you're probably looking at a modest up year after a flat January. Actually, when we come back next week, we'll probably show you the first 5 days January indicator. So over to you, Lawrence, for the 10-year yield. We've made a move here. I guess part of it is the solid economy. Part of it is the Fed. What do you think's going on here, and what's your near-term outlook for the 10-year?
Yeah, so this it's been mostly one way higher for Treasury yields, particularly in the month of December. As I mentioned, 10-year Treasury yields higher by about 50 basis points. In December, up about a full percent since the Fed started cutting rates. So there's really is a kind of a I would call it a kind of a back to normal looking Treasury yield curve right now, because if if you remember, we've had a very inverted yield curve. The expectations out of the fixed income markets was that a recession was going to happen. The Fed was going to cut aggressively. Those things don't seem to be happening. So this is really the unwinding of a lot of these, call them negative outlooks for the economy. So the increase in yields, I think, is just we talked about this in our outlook piece. It's just kind of getting the yield curve upward sloping again, and that is, I would argue, a healthy development as long as the economy can withstand a higher 10-year Treasury yield, which for all intents and purposes it looks like can, at least at least initially. But in terms of the drivers of the move higher, we have seen inflation expectations tick up a little bit, better economic growth, but really the big move higher has been twofold: pricing out a number of rate cuts by the Fed throughout 2025, 2026. But then you've also seen something that's kind of technical within the fixed income markets. The Treasury term premia has started to increase as well. The Treasury term premia, that's just one of these wonky fixed income things we talk about. It's the additional compensation that investors require or demand to own longer maturity securities. That was negative up until recently. It's starting to kind of revert back to its longer term averages. And I think, as long as the economy continues to perform well, as long as the Fed doesn't necessarily need to cut rates aggressively, we could see yields continue to move higher. There's been some discussion about 5%, 6% on the 10-year. I think 5% is realistic. 6% might be a kind of a worst case scenario, but it wouldn't surprise me if we do get that 4.75 or perhaps even touch 5%, as long as the economic data continues to come in kind of in line or even better than expectations.
Yeah, so that's more of a near-term outlook, right? I mean, we're still at
Yes.
4.25 for a long-term, 1-year plus outlook, right?
Right. So for the end of the year, I still think we are going to have rates lower because perhaps paradoxically, the longer interest rates stay higher, the greater chance of an economic slowdown. We've talked about how the economy is less interest rate sensitive right now. That's not going to last forever. People are going to want to move eventually and get a new mortgage on a house, and eventually that's going to bite into consumer balance sheets. But so I think as we get through the year, we're likely going to see interest rates around 4.25 because of kind of an incremental slowing in the economy. Nothing that would be cause the Fed to cut rates aggressively, but I think there could be some maintenance cuts in 2025 towards the back half of the year that aren't really priced in right now.
Yeah, not a lot of people can want to sell their house and buy a new one right now, right? But if you are in a position to take on a new mortgage, would you tell those folks to wait based on your outlook for the 10-year?
I mean, I think that I don't think we're getting back into that zero interest rate policy. I think ZIRP is behind us. The 3% mortgages are really behind us as well. There's 5 to 6% is kind of, I would say is probably a more normal mortgage rate. So if we get back to around 4% on the 10-year, maybe you get 5.5, or even 6% mortgage rates. I think that's kind of the lowest you're going to see absent any sort of economic contraction. So you don't want to wish, frankly, for a lot lower mortgage rates, because that means the 10-year Treasury yield is significantly lower, which means the economy has weakened substantially as well. So I think 5 to 6% is kind of what to expect on a go forward basis.
Yeah, although you get lower house prices and maybe a better time to buy. So tough call certainly, but thanks for that, Lawrence. I guess the bottom panel here is the point I just mentioned, right? The rates are up partly because the economy's been strong, and the outlook from most economists, including ours, is that it's going to be pretty good going forward. I know you watch this relationship, yields versus the economic surprise indexes, whether it's from Citi or Bloomberg. Looks like these have disconnected lately. So would you interpret this to mean that maybe yields have to come down?
I would say if you look at the middle chart and the bottom chart, I think those are pulling in opposite directions, and right now that Treasury term premium chart is kind of winning the day. If the economic data comes in, the economic data, surprise data, is still positive, so that means there is still positive surprises out there. It's just kind of decreasing relative to what it was. If we start to see those economic surprise that economic surprise index turn negative, then you could start to see yields fall a little bit. But until that happens, that Treasury term premium is really, I think, going to continue to push yields marginally higher.
I guess economists are doing a pretty good job of forecasting right now because that's pretty close to neutral.
Right.
I guess in theory where you want to be.
We'll see how Friday goes with the jobs report.
Yeah, that's the big one.
Yep.
For sure. That might really be the only economic report that matters this week. So let's go to our report card. So we went through all of our tactical asset allocation calls, equities and fixed income. We didn't get into alternatives, but certainly the majority of our allocations in stocks and bonds. So we went through all of our calls in our weekly market commentary this week, which you can find on LPL.com, and just walk through the winners and the losers. And thankfully, we got more winners than losers. It was a really good year, all in all. We had some misses, but really good year. I think the toughest test possibly of the year was to stay in equities, despite all the really credible bearish arguments. Certainly, I think the number one bearish argument was probably narrow lead, concentrated market, and high valuation big tech, right? And so we stayed in the market all year, right? Our tactical asset allocation recommendation on equities was neutral all year. It was very tempting to downgrade at points, even when the S&P 500 went above our year-end target, actually pretty significantly above our year-end target. So we thought equities were overvalued, certainly for the majority of last year. But as we always say, valuations aren't great timing tools. So we were looking for something else to tell us to sell, and we never saw it. So shout out to Adam Turnquist for the use of technical analysis, which was certainly a big piece. And our expanded quant work certainly supported staying in as well, despite the fact that the market was led by these certainly expensive big tech names. So that's the Magnificent Seven I'm referring to, which is kind of this turquoise colored line that's way above all the other lines. Equal weighted Mag 7 was up like, what, 65%, something like that last year. And then the S&P still strong, but up about 23 on a price basis. The equal weighted index did even worse because you lose the boost from the big tech names that become smaller weights. Related to that, it was tough to stick with growth last year, and we did. We were in growth all year. That was the right answer, certainly. Based on the Russell 1000 style indexes, growth outperformed by 18 points over value. And here again, same story. The big techs, despite being expensive and despite being, upwards of 40% of the market, the momentum was there. It remained strong pretty much throughout the year. We never broke the uptrend. So we've stuck with growth. At some point, we'll rotate into value, probably going to come in 2025 at some point as the earnings growth gap narrows. Right? Remember, fundamentals back up the strength in big tech because that's where you're getting the strongest earnings growth. That's where you're getting all this AI investment. So at some point that'll slow. The earnings for the value side will pick up, particularly cyclical value. They just haven't really closed the gap very much just yet. So at some point valuations matter. We're just not there quite yet. So these are kind of all tied together again, because here's the US over international, right? Bottom line, US tech-led was so strong that the other markets in the world without as much big tech and AI weren't able to keep up. You also had a 7% gain in the US dollar last year, which made it hard for international to keep up as well. And you end up with, again, the S&P 500 up 23, the EM index up 8, and then the EFA index for developed international up even less than that. Europe had a tough year in particular. So US dominated. We favored the US all year, underweighting EM, and that was certainly a profitable trade. So That's kind of high level style and cap, um, or asset type, we'll say, and style. Cap, actually, we didn't really add any value because we were pretty neutral the whole year. I do want to quickly mention sectors before I hand it over to you, Lawrence. Made two good calls in sectors in particular, really good actually. Communication services was the #1 rated sector, #1 performing sector for the entire year. And we had that sector overweight for the entire year. So that was a huge win. It was up over 40. We also had real estate as an underweight all year, and that sector was only up 5. So that was certainly a win. We, by the way, continue to like comm services, really strong earnings growth. There's a lot of AI in there with the biggest holdings in the comm services sector, Alphabet and Meta, and the technicals continue to look quite strong. Valuations aren't even that high, frankly, relative to the market. So continue to like comm services and continue to underweight real estate. Kind of mixed fundamentals, not terrible, but you've got interest rate sensitivity there. We'd prefer economic sensitivity to interest rate sensitivity. So still recommending an underweight to real estate. And then lastly, the big miss was energy. We recommended energy for the first 8 months of the year, and it underperformed by 8 percentage points. We just put too much weight on the capital allocation decisions, which were better, and not enough weight on the price of oil, which really weighed on the sector for much of 2024. So we did downgrade the energy sector in September and then again in October, which was a smart move because you had more underperformance from September through year end, but did detract a little bit from our asset allocation in the first 8 months of the year. So there was our big miss. Consumer discretionary was a little miss. We underweighted consumer discretionary in the first part of the year when it did quite well, but did go to neutral later in the year, and kind of mitigated, I guess, the potential for more opportunity costs by being short consumer discretionary. So that was another miss. But again, high level, all in all, we did pretty well, getting more hits than misses. So how about the fixed income side, Lawrence? I think probably say the same thing, more hits than misses there too.
Yeah, I would think so too. I mean, you could really argue that last year was a pretty kind of disappointing year for fixed income markets. I think the ag was only up about 1.2%, so it underperformed its coupon payments. So it was kind of a challenging year for fixed income. A couple things stand out in terms of hits within the fixed income markets, though. We had a general overweight to fixed income funded from cash. And we kind of we exited that position when interest rates, the 10-year Treasury yield was around 3.6-ish%. So we made that was a good call to overweight fixed income relative to cash. That trade worked well, and since then we've kind of been neutral fixed income, neutral duration, as we've seen the interest rate environment change and continue to move higher. The 10-year Treasury yield is about 1% higher than close to where we exited that trade. So I think that was a good trade on the margin. But the big winner within the fixed income markets was our allocation to preferreds. We've had a allocation to preferreds since March of 2023. That was right after the regional banking issues with Silicon Valley Bank. We had the concerns that the regional banking system was in danger because of some of their positioning that was offsides relative to what the Fed was doing in terms of rate hikes. A lot of their safe fixed income asset exposures were heavily underwater, and that caused a lot of kind of frustrations for regional banks in general. So we got that proverbial baby with the bathwater sell-off in March of 2023. We added to that, or we initiated a position in preferreds then, and we've kept it going up until towards the end of last year. It turned out to be kind of and I'll use 2023 and 2024 in terms of winners. Each year was up about over 9% in preferreds in 2023, and another close to 10% in 2024. So really good fixed income returns because of that preferred trade. We've reduced our allocation and kind of downgraded our recommendation preferreds. We still like preferreds, just not as well as we did, kind of call it 20% ago, when we got initially involved in preferreds. But so there's still a good story. What we're showing on the screen though is the misses, if you want to call it a miss, and this is really kind of an error of omission versus commission, I guess, and that we didn't have a lot of exposure to the corporate credit markets. If you look at the high yield market, it was up close to 9% last year as well. We've not been interested in the high yield corporate credit market, frankly, because of valuations, and that's what we're showing here. These are spreads relative to Treasury securities. The tighter those spreads are, the lower those numbers are, the less attractive, the more expensive they are. The corporate credit markets have been expensive for a while, so we didn't really get interested in high yield markets last year. High grade, same story. High grade, these investment grade corporate issuers, they outperformed the broader index last year. We had an underweight recommendation for high grade or investment grade corporate bonds. I will say though that we did have an underweight to the sector, but we liked the short to intermediate part of the corporate credit universe, and that did outperform the broader index. But we still nonetheless had an underweight recommendation there. So it really came down to valuations. Our expectation was an economy that was going to slow, and maybe we thought we would see wider spreads at some point in the year last year, and it just never came to fruition. So we kind of missed out on that, if you will. But our allocation to preferreds, I think, offsets what we got wrong in the corporate credit markets.
Yeah, so maybe a bit of an opportunity cost by not, pairing an overweight to credit with the overweight to preferreds. But managing risk isn't a bad thing. Sometimes the risk doesn't appear when you manage for it, but it will at some point, and we'll probably still be here cautious on corporate credit when it does. It's also important to keep in mind, and you alluded to this, Lawrence, when you have an overweight, you have to fund it from something. You have to be underweight something else relative to your benchmark. So the fact that we, moved from credit to preferreds certainly was a decent trade and not a miss.
Yeah, I guess the perfect trade, if you will, would be underweight kind of securitized that underperformed the index broadly, and then kind of overweight corporate credit. But from a risk management perspective, that probably would be too risky alongside an equal weight allocation to equities. So I think on a risk adjusted basis, it still made sense. But we're hard graders here in LPL Research.
There you go. Hard to get straight A's from this team. And you could have put a winning chart in here, and you chose the losing chart. So how about that?
I'm going to wear my losers proudly, and
high integrity. There's no sugarcoating here.
No place to hide.
That's right. But again, overall, a pretty good. It was a tricky year in some respects for equities and fixed income. So handled it well, and I think for those of you listening who are LPL advisors and followed our advice, I hope you would agree that it was a good year. So let's keep going and move on to the week ahead before we wrap. And I think this is going to be a fairly quick discussion because the payrolls report on Friday is really, I think, the big event of the week. And I mean, in talking to our economist Jeff Roach on our internal call this morning, it was all about jobs for him, even the other data points. The JOLTS report, job openings and labor turnover, that quits rates, that's labor market, right? He said with the ISM, what we should be watching most closely is the employment component, right? Which I think was a little bit soft in the manufacturing ISM, right? And then payrolls and wages obviously are important for the labor market as measures. So, and then the Fed cares about the labor market really more than the broad economy. You could argue that's their mandate, labor. And we get Fed meeting minutes for the last meeting, the December 18th meeting. So that's about labor. So basically, I told you that the whole week is about the job market. What do you think, Lawrence?
Yeah, I think that's right. Just adding to that, there's a couple Fed speakers this week as well out there, and these are, I mean, if you look at kind of past commentary from some of these speakers for this week, they have been kind of more on the hawkish side, more concerned about a still relatively healthy job market and still relatively high inflationary pressures. So, yeah, I mean, whatever happens on Friday or with the job market on Friday is really going to kind of set the tone for the weekly performance for markets just in general. I think Fed officials can come out and say whatever they're going to say, but if there's a big miss in either direction, frankly, on the jobs report on Friday, that's going to supersede anything else that happened throughout the week. So it's all about the jobs week on Friday.
Yeah, I mean, just based on the move in yields, the market you would think would digest a slight miss pretty well. Something around 100,000 probably wouldn't be too disappointing for markets. I mean, we'll have to see, but with consensus at 160, anything between 100 and 200, I would think would be fine. We did 227 last month. It's when you get these really big surprises that the market gets confused and tends to move. Like we had a few months ago with that really low number, the hurricane distorted number. What was that? September. So barring that, it'll probably be pretty calm. And rates have moved so much here, Lawrence, that I mean, anything could happen, but I think that the odds that the jobs report drive a sharp surge in yields from here, probably low.
Hope you just didn't jinx us.
I hope I didn't jinx us.
the
We'll see.
the
Well,
range of
here, this is an
expectations.
equity strategist talking about the bond market and the economy.
Yeah.
So, take it for what it's worth.
The expectations for Friday's job number, though, 120 to 200,000. So still a pretty broad expectation. So to your point, I think if it's within that 120 to 200,000, maybe it's kind of expected, if you will. But if we get another kind of blowout report that's above 200 to 225 or something like that, then there still is call it 6 cuts priced into the market for next year. If we continue to get a hot jobs number, though, those could get priced out as well, which would push bond yields higher. But hopefully, it's more in line. We talked about economists getting it right. Hopefully they're getting it right for Friday as well.
Well, we can blame Jeff Roach if that number is strong, because we could continue to hear from him. I'm saying this obviously in jest, but we continue to hear that there's a plethora of evidence that the labor market is slowing. So the bias going into this payroll, and it is, right? The bias is down. We're down 60, 70,000 jobs based on consensus. You would think that, again, based on the other data, the whole mosaic, that you're probably more at risk of a weaker number than a really strong number. So I'll make that case. Could be wrong. Been wrong on calling the jobs report before many times, but the weight of the evidence supports the slowing job market thesis from Jeff Roach and our team. So Friday's the biggie, and we'll certainly be closely watching Fed expectations after that. So thanks for that, Lawrence. Any closing remarks, or should we wrap it up?
Oh no, let's wrap it. It's a busy week, and hopefully everyone is well rested after the holiday break and ready for some market excitement.
Yeah, first market signals of 2025, first of many. So thanks for joining. Thanks for your interest in LPL Research and the LPL Market Signals podcast. Everybody have a wonderful new year. Take care, and we'll be back with you next week.